Another idea that you've got that I think is fascinating is this whole idea of like buying the dip may be suboptimal, and I think it really gets at this whole question of like, if I have a pot of money, should I just put it all into the market today, or should I try to dollar cost average over time? And I know you've done some work on this. Like, how do you maybe just like frame the question that you're trying to actually answer, and then what is the answer?
Yeah. So let's use a more like ridiculous thought experiment, right? Let's say you had $100 million and you have to like preserve that purchasing power over the next 100 years. You have two options. You either get it all invested right now today, or you put in $1 million a year for the next 100 years. So I know you already know the answer to this, right? Like, why would you wait? Why would you put in $1 million a year for the next 100 years? Inflation's going to eat you alive, right? Like I don't like holding cash. So as a result, like it's obvious that you should put it in immediately. We'll take that general idea and generalize it down, right? If you wouldn't wait 100 years, you shouldn't wait 100 months, you shouldn't wait 100 days, right? Like that, because generally, prices go up and to the right for asset classes over time. That's not true of every market all the time, but for most markets, most of the time, that's what happens for at least income producing assets. So because of that, you're not going to want to wait. And I've tested this in so many things, like putting the money in now versus waiting and putting in over time. And this is true. I've done this with gold. I've done this with Bitcoin. I've done this with, international stocks. I've done this with the US stocks, et cetera. And all of them, it's better to like, on average, like 70 to 80% of the time, it's better to start and invest now instead of waiting for dips and things like that. Because usually when you wait for these types of dips, the dips will happen, but by the time that dip comes down, that's at a higher price than you could have bought originally. I think one of the best examples of this is I actually started talking about this in early 2017, and people were like, oh, the market's too overvalued, I'm not going to buy. And since then, like the market's doubled. But even if you had bought like at the bottom in March 23rd, 2020, you still would have bought at prices like 7% higher than if you had just bought in like early 2017, which is kind of shocking. Like even if you could perfectly time the market and get the best dip possible, like 3 years after, when I first started talking about this, you still would have bought at higher prices, which is kind of crazy to think, but that's kind of how dips happen, right? The big dips are rare, and big dips are incredibly rare.
Yeah. And that's why it goes to this whole idea of like, just like time in the market is more important than timing the market, which is, a really cute saying, but there is a ton of truth to this. And I think that data kind of backs it up.